Happy Friday and happy Memorial Day weekend. Brian Manning here with your weekly update. Let's get right to it. So Monday this week, bonds started off a little bit worse, which certainly isn't great for interest rates, and kind of went through a little bit of a rocky week and a lot of data coming out as usual. Tuesday was rather benign with everything that's going on in the markets. On Wednesday, had the mortgage bonds rebounding just a little bit, which helped out interest rates, caught them to go down a tad. We received the Fed minutes from their last meeting. And luckily, most investors are already factoring in what the Fed is doing right now. And the release of the minutes when they got analyzed didn't really cause too many jitters in the marketplace. So certainly good to see there. Thursday this week, we got data on existing home sales. And existing home sales for the month of April were down, which certainly caused some negativity in the media. And the media is always looking for something to pick up on. And, the big challenge was this. March's existing home sales were the absolute best ever. And they even went back and further revised March's numbers and made them even better and added a larger amount of existing home sales onto there. So when you're coming on the heels of a report like we had in the month of March, and then you're looking at April, very doubtful that a report in April would be in line with as strong as March's report was. So when you get something that's not in line month after month, the media picks up on it. But at the end of the day, year over year existing home sales are still very strong and certainly looking incredible on national statistics as far as the housing market is concerned. And the real mover of the week was today. So earlier today we got a report on the CPI, which is the Consumer Price Index. And this is a gauge that measures inflation for us at the consumer level. So headline inflation was up 0.1%, which was exactly in line with what analysts were going for. But what we look at is what's called the core rate. So the core rate strips out food and energy and looks at what the other remaining costs are for consumers and what the inflation is associated with these costs. And when we strip out food and energy, the core rate was up 0.3%, which doesn't sound like a lot, but in the realm of inflation, it's actually a pretty decent amount. So the concern here is that the Fed's target is that they want to see the core rate of inflation going no higher than 2%. And that's kind of a gauge that they're looking at before they're going to start increasing rates on their side. So coming into summer, it's actually going to be really important for us because if we continue to see the core rate of inflation on the CPI up 0.2%, maybe 0.3% in June, July, and August, that's actually going to put our year-to-year or year-over-year inflation somewhere between 2.2 and 2.6%. And again, the challenge is the Federal Reserve wants to see inflation at 2% or lower. So if we start moving into a position where inflation is 2.2 to 2.6%, at that point in time, it's probably going to cause the Fed to react. And typically the downfall is that inflation is the enemy of interest rates. Anytime there's inflation, it causes a reaction in the bond markets and it causes mortgage rates to go up. So we definitely want to watch the inflationary data that's coming out through the summer very closely because that certainly could have an effect on all of us. Again, happy Memorial Day weekend. I actually will be around all weekend. If you have any questions, please give me a call. If you're looking at homes, a realtor with working with a buyer, you want to get pre-approved, please give me a call. I'd love to help you and certainly be part of your business. Have a wonderful day.